Well, good morning, everybody. I hope you're enjoying your Saturday afternoon. I'm here to bring you some fear mongering, but also some hope because a lot of you are concerned about a stock market crash in 2025. We have gone through an insane bull market in the United States for the past 15 plus years. In the past 2 years, I believe we've had 20% plus returns in the S&P 500 back to back. And guess what, ladies and gentlemen? We're not going to get that forever. There will, I guarantee you, be some kind of correction, some kind of downturn. And if valuations get stretched enough, even the best companies in the world, including US stocks, bro, could potentially see massive losses into the future. Now, if you want to prepare for a stock market crash in 2025, if you think you're a market timing genius, you might go and search the web for hedges to protect your portfolio. You want safety. You don't want to lose everything because the stock market goes down 50%. And if you do have capital losses, it's basically over for you. So I'm going to give you a couple options backed by some data to show you how to protect your portfolio. Let's dive right into it. And yes, we will mention specific ETFs. But before we do that, I want to talk about something that's even better hedge of your portfolio. The first hedge of your portfolio is going to be time. Time cures all wounds. If you are a long-term investor like me, 30, 40, 50 years, investing your entire life, that's your time horizon. You don't need to worry about a stock market crash. You don't need to worry if stocks drop 50, 60, 70%. Would that be bad? Yes. But if you, in the long term, believe the world is going to be a better, more profitable, more productive place in 20, 30, 40 years, any market fluctuations in the near term are irrelevant and should not panic you, and you should continue to DCA. This is my personal strategy. I'm going to mention some other ETFs that you could buy, potentially to hedge against a stock market crash. But I personally am not buying these ETFs. I am personally dollar cost averaging into a 100% total world index fund. I'm 35 years old, probably not selling these stocks for 30 years. If the market crashes, I will continue to DCA. That's all I'm going to do. I'm not buying a dollar of these ETFs. But maybe if you're closer to retirement and you're 100% stocks, maybe you should consider hedging your 100% stock portfolio into something else. Now, this is not specific financial advice, okay? Go find a financial advisor, pay them a fortune. This is just my personal opinion. Don't sue me, bro, okay? And no, we're not talking about Bitcoin. But getting back to time, time cures all wounds. Time is your friend in the stock market. And if you look at the real GDP forecasts, this is from the OECD, look at how they're forecasting the growth of GDP. So right now, global GDP is $63 trillion. And their projections over the next couple of decades is more than a doubling of global GDP. Now, obviously, it's a straight line. It's probably not 100% accurate. But I firmly believe the world will have a higher GDP, real GDP, in 20 or 30 years. And that will have some influence on stock prices. Okay, so I think in the long run, humanity will get better and stock prices will reflect that. That's my personal opinion. Okay, but that's a long-term mindset. In the short term, you need to look at what's called correlation. If something is highly correlated, it is not a good hedge. If I buy Apple and Nvidia, well, they probably move roughly in tandem. They're both in the US stock market. They're both techie. They're both large cap. If Nvidia is going up, Apple's probably going up. If Nvidia is going down, Apple's probably going down. If you want to protect your portfolio, I don't know why you would buy two things that are highly correlated. It's like buying VTI and VU. VTI is total US. VU is S&P 500. They almost have a perfect correlation. So there would be no reason to buy them unless you want to use some kind of like tax loss harvesting strategy in your taxable brokerage account. Correlation, you need to understand correlation. So I pulled up this thing from Guggenheim, and it basically shows the correlation between different asset classes. Let me see if I can zoom in a little bit more. So basically, the higher the percentage, the more something is correlated to the S&P 500. If the S&P goes up 1%, something else goes up 1%. If it goes down 1%, this thing goes down 1%. But the lower the percentage, the less it's correlated. And if it's negative, there's actually a negative correlation. So something goes up, something goes down. This thing goes down, okay? So we can clearly see from the historical correlation of various asset classes versus the S&P 500, January 2013 to December 2023, the S&P 500 is 100% correlated to the S&P 500. Did you know that when the S&P 500 goes up 1%, the S&P 500 goes up 1%? Nice. Global, 98% correlation. Basically, they march in lockstep, okay? That's at least been the historic trend. Long, short equities, 87%. Not sure what that means. International equity, 84% correlated. So in the past 10 years, international stocks have been 84% correlated with U.S. stocks. So if there's a stock market crash, I would not say that just having international stocks is going to necessarily protect you. And I agree with that sentiment. I don't think, oh, I got international, so I don't have to worry about a U.S. stock market crash. Okay. But keep in mind, this is only from 2013 to 2023. I bet you these correlations would be different if you looked really far in the past, okay? Because obviously there's been differentials between international and U.S. They've changed performance over time, back and forth, back and forth, back and forth. So the most recent 10 years offers a pretty high correlation, but not necessarily in the future. That's why I buy international stocks, bruh. Hedge funds, 77%. We're not investing in hedge funds, okay? We're not doing that. Events driven, what does that mean? No. REITs, 72% correlation. Now, you could buy REITs and, kind of hedge your portfolio against the S&P 500, right? But it's still pretty correlated. If the S&P goes up 1%, REITs go up 0.7%. Basically, that's what that means. But they're still correlated. So if there's a market downturn, REITs are also going to go down. Maybe not as fast, but there's a correlation there. So as we go from right to left, we can see that we're getting lower and lower. Let's see, commodities. So people say, oh, buy gold, commodities, silver, blah, 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 blah. That's going to hedge your portfolio against a crash. I don't necessarily believe that. It's a much lower correlation, but I don't want to buy something that is basically has no cash flows, it's hard to value. It's just based on what people pay for the asset. I don't think commodities are the best hedge. You're just buying a basket of goods. They're used to produce things, but they, in and of themselves, do not produce anything. But there is a much lower correlation, but they're still positively correlated. Equity market are market neutral. Sounds like a high, basically some kind of fund that, uses puts and whatever, hedges. No, I wouldn't do that. Too expensive. Managed futures. We're not getting into futures. We're not getting into the futures market. You're a retail investor. Stop. Don't go on Robinhood and trade futures. But here we get to the crux of the matter. What is actually the best hedge? In my opinion, and this is confirmed right here, the best hedge against a market crash, it ain't gold. It ain't international stocks. It ain't REITs. It ain't silver. It ain't oil. It ain't chicken poop. It's cash and investment grade bonds. Lastly, we have currency, which is inversely correlated to the S&P 500, but that's basically because it's just being devalued all the time. So you can't really invest in currency. I mean, you can, but I wouldn't do it as a retail investor. I wouldn't touch managed futures. I wouldn't touch equity market neutral. Sounds like high expense ratio market hedging garbage. Commodities are still somewhat correlated to the S&P, so they can go down too. REITs, that's in the S&P 500, or at least in the total market index. The best hedge, in my personal opinion, is cash and investment grade bonds. But you need to be extremely careful here, okay? Bonds in and of themselves aren't going to protect you. Bonds in and of themselves are not safe. They have risk. The biggest risk is duration risk. The biggest risk of a bond is when the bond matures. When you get a bond, when you buy a bond, you get a piece of paper, you lend money to the government or whatever. Government pays you interest every 6 months or a year. You collect that coupon. And at the end of the bond's life, when it matures, you receive your initial investment back. So I give the government $1,000. They pay me interest for 10 years. And at the end of that 10 years, I get the bond back. I get the $1,000 back. That's, basically how bonds work. Obviously, there's more to it than that. But the problem is, the big problem is if you have a distantly dated bond, think about that. Let's say you buy a 30-year bond from the government and you give the government $1,000. You're not getting that $1,000 back for 30 years. I mean, you could trade it to other people, but you're not getting that $1,000 back for 30 years. And think about the time value of money. Think about inflation and discount rates. What that does, it reduces the present value of that future payment that you're going to receive massively. So when things change in the market and discount rates change or risk premiums change, that has a bigger impact on long-term bonds. So if you think you're going to hedge the S&P 500 by buying TLT, long-term bonds, long-term government bonds, you're wrong. Look what happened to TLT. The Fed raised rates to fight inflation in 2021, 2022. Stocks collapsed and TLT collapsed. But it's a bond, bro. When rates go up, bond prices go down. The further out the bond's maturity, the more it goes down. So if you really want to hedge yourself, it ain't gold, silver, this, that. It's cash in your bank in a money, like a federal money market, in a certificate of deposit, or it's short-term government debt. Now, there's a couple options that I personally like. First one is SGov. I've talked about SGov before. 0 to 3 month treasuries. Treasuries are paying, short-term treasuries are paying like probably 4.2 or 4.5% right now. They keep cutting the short-term rates. But they're still paying a pretty decent real yield if you trust the current inflation metrics. And they don't fluctuate. So if there's a crash next year, this thing, well, it's not guaranteed not to fluctuate. Of course, nothing's guaranteed because it's short-term and it's federal debt. It's basically the safest thing out there. SGov will probably stay around $100. Now, you see these oscillations here, but these are like a couple cent moves, okay? Down here, it was $100, and now it's $129. Almost no fluctuation. There's another one called the Bill ETF, the Spider Bloomberg 1 to 3 month T-bill ETF. Now, once again, you see some red, right? Oh my God, it went down, bro. It went down 0.23%. Look at that over time. It barely moves. It hovers around 91.50. Sometimes it goes to 91.40, 91.60, but it basically stays around 91.50 because it's short-term debt. There's no time risk, very little time risk because the government's going to pay you back in 1 to 3 months, and there's very little default risk. Basically, it's non-existent because it's the federal government, okay? So these are like short-term hedges. These are real hedges. Not freaking treasuries. Let's go look at long-term treasuries here. This is TLT. Look at the fluctuations. It's down 11% year to date. It's down 12% the past year, and it's down 36% in the last 5 years. These are bonds, but that doesn't mean they're safe because they're long-term bonds. So it's basically you're stuck, in my opinion, with cash or a cash equivalent through the SGov ETF. Or something like Bill, which we just looked at. And awesomely enough, I am pleased to announce, they obviously didn't talk to me about this. Vanguard is going to offer short-term treasury ETFs, but they have lower expense ratio. They're going to offer I think it's in the first quarter of 2025. They're going to offer, it's going to be called VGUS and VBill with an expense ratio of 0.07%. For my short-term cash needs, I'm probably going to put my money in this. Okay, these are short-term federal treasuries. The only major risk is reinvestment risk as rates come down. But it won't fluctuate, at least I don't think it will, if stocks crash because of the inherent qualities of short-term federal treasuries in the United States. So that's your hedge, okay? I wouldn't do this other complicated crap. So remember, it's time. If you're a long-term investor, crash doesn't matter. Doesn't matter. I don't care. I really don't. But if you need the money soon, you might want to consider cash or short-term government debt with a low expense ratio. because that'll protect you. It also has some tax advantages, whereas you only pay federal tax. You don't pay state tax on federal debt. So that's your hedge, ladies and gentlemen. What do y'all think about that? Are you prepared for the crash? All right, let's do some comments. And I don't want to hear Bitcoin. I don't want to hear freaking Bitcoin. It's not a hedge against inflation. It's not a hedge against a stock market crash. Shut up. Book a free tax consultation with me. I'm a certified public accountant. I do business and personal taxes throughout the United States. You can talk to me for free. I'll give you an upfront quote, and I will do your business and personal tax returns fully digital. Me, I'm the only employee of my business. I will sit right here and do your taxes. Book a free consultation now. Doesn't cost you a penny except for your time. Always be buying. I agree. Finally caught alive. Welcome, Brian. I sold out all my positions. I agree. Something bad is coming. I'm getting ready to start shorting the market. Well, I wouldn't recommend that either, Gil. Just buy and hold an ETF. What are you doing? Stop. You're young. Arms are actually pretty jacked. I know. I actually had a little arm injury, so I'm taking a break from lifting, but I've been running like a beast. Productive, yes. Better, no. I mean, when it comes to like GDP and stock prices and valuations, I think we're going to be fine in 30 years. Well, I mean, I could be wrong, but we'll see. Let's see. Good stuff. Thank you. Meat smoker, fake meat smoker. I need to cover the PP ETF. I don't think Meat Kevin beat it. I don't think Meat Kevin beat inflation. Imagine that. People say VT doesn't beat inflation. How much is VT up this year? VT, bro. Doesn't beat inflation, bro. Yeah, Michael Saylor, bro. Let's see. How much is VT up? Year to date, it's up 16.56%, excluding dividends. I guess I underperformed inflation this year, boys. Dang. What a disaster. Strong man, I'm so glad I found your channel by accident back in 2020 because everybody else was spewing garbage. Oh, and it's getting bad again, brother. It's getting bad again. The best hedge is a short. No, it's not. We're not shorting. We don't short on this channel. Okay? Okay, well, I did buy like a couple $100 of some puts. Okay, I admit it. I'm a fraud. I get it. But like for an actual legitimate like portfolio-wide hedge, you can just do cash. Why do you need to hedge short stuff? Look what happened to everything money. In the late 80s, everyone said the place to invest was Japan. Correlation, it was up 1%, and it was a total U-turn. Yeah, people say international and the U.S. are correlated. Well, if highly correlated, well, if they were, they would both have roughly the same returns. But they're not. So there's not a correlation there. Or not a strong correlation. What I find the funniest part about Bitcoin is you can power 61 homes for one. Oh, it's the future, bro. Buy Bitcoin to hedge against inflation. How much did Bitcoin fall when the Federal Reserve raised rates? Oh, yeah, that was a hedge, bro. But you know what was an actual hedge? Short-term government debt. And you started getting paid more money for it, too. Yes, agreed. Short-term T-bills, yeah. Look, I don't like short-term corporate debt. I mean, you might get a little bit higher yield, but you pay state tax on it, and corporate debt can drop. There's a safety difference between corporate debt and federal government debt. Federal government debt is a little bit safer than corporate debt. Okay, federal government has limitless power. It's the U.S. federal government. What's going to happen? Oh, my God. A little bit naive. What is the point to buy, do it 4 years and a year almost get the return? What is the point to just buy at the 3 month and do it 4 years times in it? No. That's an annual rate. The rate you see is an annual rate. It is not a quarterly rate. Trust me, if that was a quarterly rate, people would be piling into federal. I mean, the S&P 500 would probably collapse if that was a quarterly rate. It's an annual rate. So if you annualize it, you would get 4%, not per quarter. That would be, dude, I could get 12% roughly from bills, but I'd probably be freaking retired right now. Okay. Excess cash is not detrimental to your wealth. For most best things, don't try to hedge and stick. I mean, some cash is good. Like I have cash, not a lot, but I have it. But it's not to buy the dip. It's because I need it for short-term needs. So if something happens, I don't have to sell my stocks to pay for a bill. I agree. Or the new Vanguard funds. Glad Echoes isn't here complaining about nothing, but you are wrong, strong man. Yeah, I'm sure Echoes has a better hedge. Okay, I'm sure Echoes knows the better way to hedge your portfolio. I will. Strawman, somebody hacked your account, is putting out stock. Yeah, they hacked my likeness too. Watching Strawman at work right now. I love you, bro. Working on Saturday. Poor boy. I've been there. Let's see. You think crypto is a bubble? There's nothing. Yeah, crypto is inherently a bubble. Crypto is always a bubble because it's fundamentally worthless. Doesn't matter what the price is. Bitcoin could be $1. It's still a bubble. It's worthless. Hey, Strawman, as a young investor, I believe that risk can be much higher. Therefore, all stocks, no bonds. What do you think about a portfolio mostly QQQM? Well, that's a large tech ETF, and then you have a dividend ETF. So you're basically investing in 200 stocks. Like, why not just buy the whole market? You get the same stocks, but at market cap weightings. Why do you have to buy 2 ETFs? Why not just buy one? You get all the stocks in a total US or total world. Bitcoin flash crash from 12K to under 45 at the start of the clown-demic. Anyone with leverage got... It's a hedge, bro! QQQ is going to drop 50%. I mean, what did it drop? Like 35% in 2022? How much did SGov drop? Nothing. How do you make these AI thumbnails? I use Grok and I use Facebook. They're both free. And if Grok starts charging, I might pay for it. Let's see. Both of y'all suck at investing, but you are... Oh, I'm the bad investor guy. I suck at investing. Yeah, you're amazing, Internet Warrior. Teach me your ways. Buy chip stocks. Let's see. Hope everyone's using a Roth. I mean, unless you make a lot of income. Why would you use leverage in crypto? That's all. They're all levered up. What do you think Michael Saylor is doing? Bitcoin to 150K? He's levering his portfolio. How should I go about rotating capital from those 2 ETFs? Well, you're going to you got to be careful because if you sell it again, you're going to be paying taxes. So you got to talk to a CPA like me. I'll do your taxes, oh, by the way. But there's a lot of considerations, okay? If you have massive gains in those accounts, you're going to pay taxes when you sell it, unless you're inside a tax advantage account. So you got to really I would just go to bogleheads.org, read up, kind of understand what the whole philosophy is. And then eventually, once you figure it out, you'll be able to make an accurate plan. I wouldn't just rush and sell everything and do this on Monday or whatever. Research, learn a little bit more, bogleheads.org, and then you can make a decision. From your video about real weight, I wonder what catastrophic economic event. What happened in 1971? Corporate profits, bro. That's all that matters. Bring everybody in from the world. Corporate profits, brah. Lower that wage expense, brah. I've been in those. See, you're probably sitting on gains, dude. You got to be careful. But you need to research a little bit more and then make a decision. But if you have a lot of gains, you're going to pay some tax. Just letting you know that. All right. Well, once again, if you want a certified public accountant with over 7 years of accounting experience to do your personal or business taxes, partnerships, LLCs, S corporations, C corporations, you're looking at them. That's right. I do free tax consultations. Click the link below. It'll be a pinned comment at the conclusion of this video. I give you an upfront quote and I do your taxes. 100% digital. Everything's e-signed. Everything's super easy. Faster than your CPA. They're overwhelmed. I'm still growing. Okay. Probably cheaper than your CPA. I have no expenses. This is my office. I'm sitting in it right now. And I hope you guys have a wonderful, delicious weekend. Cheers!